Good morning, and thank you for the opportunity to address the core of the insurance industry, a much larger one in New Zealand than anyone outside the industry appreciated up until 2010, and now they think it's too small and can't do enough for them. So you can't please everybody. Can I acknowledge the Insurance Council and the work of Tim Grafton, because insurance issues have been so prominent. The Insurance Council is an entity now becoming much better known to the public, with a huge opportunity to raise further the awareness of the public about risk and the best way for them to deal with it. Also, can I acknowledge Jackie's role of leadership, particularly in the early stages of earthquake recovery, when all organisations related to that were under stress, and acknowledge her role as providing a voice for the insurance industry, particularly in its interaction with government. The issues around the earthquake have generated ongoing media interest. I think there's a reasonable level of understanding in the wider public about the natural tension between insurers and their customers when it actually comes to paying out. The only advice I can give is that we need to simplify some of the processes in New Zealand, because in Christchurch the hard work is around the enormous complexity of some of the insurance issues, and government has a role in simplifying those arrangements and making them more workable should we unfortunately have another disaster on that kind of scale. The other little piece of advice I would give is that cost escalation is becoming apparent to government in its procurement role in Christchurch, and insurers who hang on a long time are going to find the benefits of the passing of time eroded by fast-growing demand in the Christchurch market for construction services, and therefore price escalation. I wanted to talk a bit today about the context in which you're operating for the New Zealand economy, some of our own risks, and also the way that government is thinking about risk, on which you are experts, and we are still learning quite a lot. The economy, as you can see from confidence indicators, public mood, is doing reasonably well. In fact, by developed country standards, doing remarkably well. But we don't want to get too carried away, because there are, of course, risks. As a small open economy at the end of the world, there's plenty of people generating waves that wash up here, and we spend some time trying to understand who is generating those waves and what's causing them. There's a set of international risks that we're going to be dealing with over the next 4 or 5 years. Probably the one that I think is going to generate more unexpected volatility is the unconventional monetary policy operating in the world's 4 largest economies. And if I can describe it this way, the US is still printing money and has created quite a lot of uncertainty just by talking about winding down the printing press. And that's before they get to the task of shrinking their $5 trillion balance sheet that the Federal Reserve has built up. We've never done this before. So that's the US. Japan is still cranking up its money printing machine. It's got levels of public debt that no one else has ever contemplated, and it's expanding its central bank balance sheet at about 2 or 3 times the rate of the US. So Japan is in completely uncharted territory, still expanding its support for its economy, and that's before it gets to the much more difficult task of stopping and then winding it down. China is finding its way through 2 pretty significant changes. One is managing the credit bubble that they created in the aftermath of the GFC, all of which benefited us, but now they have to manage it down in a command and control economy, which is pretty challenging in itself. And they have to shift from running an economy where investment makes up something like 50% of GDP, which is incredibly high, and try and manage that down and increase their consumption. And that's before you get to Europe, the other one of the big four economies, which is still trying to dig out the problems in its banking system and finding the political solution to hold the euro together when a lot of the economic forces are tending to push it apart. Now you can imagine a relatively benign scenario where the policymakers in all four of these biggest economies get everything right. You can also imagine a scenario where they get some things wrong, and if we have that scenario, then in my view we're going to have periods of relative calm punctuated by unexpected volatility, and that will go on for some time because these countries are in a generational cycle of dealing with the consequences of the GFC. By generational, I mean it will take them something like 20 years to get through the process of winding down their public debt, sorting out their monetary policy and normalising. In our own economy, the risks are really over the next few years are around the supply side. Can we get enough people with the right skills to do the work that is coming through from the demand side of the economy? And that is particularly the case in the construction sector. Government can do so much with its skills program, but it is going to require New Zealand businesses to invest more than they traditionally have in creating the levels of skill that they are going to need. Probably a more prominent risk is around our housing market. New Zealand has one of the least affordable housing markets in the world, outside of Singapore and Hong Kong. There's no reason why we should have one of the highest ratios of house values to incomes. There's plenty of room. 4 million people in a country the size of the UK, which has something like 60 million people in it. We can choose to have a more affordable housing market with less of the debt and the leverage that goes with overpriced housing markets. That's why over the last 3 years we've concentrated pretty strongly on the regulation of housing supply. And in the last few months we've put in place the legislation, required agreements with Auckland City and others to come that will allow us to create more flexible housing supply. It's going to be a challenge, but it's one I think the public now understand a great deal better than they used to. We simply can't let a few dozen planners in our councils make decisions which can create such large risks for our economy, both around too much household debt and the threat to our export sector from the exchange rate and interest rate effects of a housing market out of control. Annual increases of 15 to 17% in the value of our housing is unnecessary, undesirable, risky, and we all need to apply ourselves to ensuring that we take the heat out of that housing market. The government's response to these general international and domestic challenges is to focus on two things. First, basic competitiveness. The business growth agenda is an awful name, but it helps you remember it. And it is a series of 6 documents that set out around 300 policy initiatives that we are taking, which focus really on a simple idea. We want to do whatever we can to support businesses and workplaces to make the decision to invest another dollar and employ another person. That's growth. Growth is not what commentators do. It's not what economic development agencies do. It's the decisions made in our businesses and organisations to spend another dollar because they think it's worthwhile, and along with that, hire another person. If there was one big thing that made that a lot easier, we would do it. But despite many years of looking under rocks, we haven't found that one big thing. So we're doing what every other business has to do in New Zealand, and that is work on most aspects, in fact all aspects of our performance as an economy. And that ranges from the very extensive infrastructure investment you're seeing here in Auckland with sort of 10-year view out ahead, most of which is funded, through to the details of the transitions for young New Zealanders coming out of school into training and into our workplaces, through to the recently announced new framework for the quality of fresh water so that we can continue to grow our protein production at the same time as ensure New Zealanders are confident that they have the clean, green environment that we advertise to the world and which they enjoy at home. And we continuously work with business, including this industry, to listen to what initiatives you think we could take to put into that business growth pipeline to continue to lift our competitiveness. I believe the benefits are starting to show up. We can't help measuring ourselves with our cousins across the Tasman, but even the Australians think the environment here isn't too bad. We've just got to turn that into attracting more of their capital back into this economy. The other part of what we're doing is looking quite hard at what government does. Government is 25% of the real economy. So if we want to contribute to productivity, one of the things we can do is perform better as an organisation ourselves, because we have direct control as politicians over the performance of government. And increasingly we're looking at the performance of government through a risk lens. The government is regarded by most New Zealanders as the risk manager of last resort. And governments, as managers of risks, has some pretty bad habits. And those habits arise from the fact that we don't have to get people to voluntarily pay premiums, we can coerce them. They pay their taxes because we make them. So we don't have to think too hard about getting customers. And for most decision makers in government, capital looks free, and it always looks like there's someone to pass the risk to. In the end, that's the cabinet. So when things go wrong, governments come up with money to fill the hole. So we're spending a lot of time trying to understand our risks better, to find ways of pricing those risks, because many of them have been unpriced or priced in ways no one understood, and allocate the management of those risks to people who are in the best position to do a good job of it. That might sound like pretty basic stuff to an insurance industry. I can tell you that to a government it's pretty radical, and is going to lead to ongoing change, ongoing significant change in our public sector. The progress we've made so far can be measured to some extent by the fact that our budget's getting back to surplus. We'll be one of a handful of developed countries in the next few years with budget surpluses. And that is because we're getting at the drivers of our spend rather than just making savings. And one of the drivers of our spend is undermanaged, badly managed and misunderstood risk. So, for instance, we're taking a look across our balance sheet to bring to it corporate treasurer type understandings of the risk that's on it and the tools that are needed to manage it. Despite the fact that we've been doing some partial sales of commercial assets, the government balance sheet continues to grow. and the part of it that's growing the fastest are its financial holdings. ACC and the New Zealand Super Fund have both grown very significantly even through the last 4 or 5 years. So we need to understand much better how to manage a balance sheet with a fast-growing debt portfolio and fast-growing managed funds portfolio. But at least for those parts of the balance sheet, there's pretty well understood techniques for managing the risks and understanding them. The real challenges are around our very large property portfolio, 17 billion worth of houses, 10 billion, I think 13 billion worth of schools, 8 billion worth of hospitals. All of these are poorly managed. That's why we've gone into PPPs, not because they are much cheaper, although they are somewhat cheaper, but because we learn so much from the discussion with external parties about what the operational and financial risks are of building a prison, of running schools and hospitals. Because when we have those discussions, the external parties who would be putting capital at risk are much more sensitive to the risks of the project and have a much better toolkit for managing those risks. So we'll continue to use PPPs, not because everything the government does is going to go into that structure, but because we learn so much from it. And if I can give you an example, the agreement around the Wiri prison out here in Auckland has yielded a whole wealth of learning that is now being applied across our whole prison system. Not just about the construction and management of the buildings, but about the drive to reduce reoffending rates, because the operator of the Wiri prison will suffer financial penalties for every prisoner who reoffends within 12 months of leaving the prison. So before it's completed, before the building's completed, they're out in the communities where their prisoners will be released, finding people who can help them prevent reoffending. So we're trying to bundle our exposures in ways that give us better performance. Probably the area where we're being more innovative as probably any other government, or more innovative, is around our welfare spend. In welfare, we are taking the technologies that you use every day, the calculation of future liabilities, and applying it to our welfare population. 1 in 12 working age New Zealanders is on welfare. That is completely dependent on you for their income, 320,000 people. The most recent future liability calculation for that group is $80 billion. That is, you will spend $80 billion just on the benefit payments for that population if they behave in the way that, or if they stay on those benefits for the duration that most people stay. And it's been fascinating to see how much more we've learnt by applying insurance industry concepts to welfare than we knew applying traditional public policy. Because what the calculations do is make it really clear who is generating the larger future costs, and therefore make it much clearer where the government should invest in trying to reduce those costs. And if I can give you an example, if you go on a benefit under the age of 20 with a child, your average length of stay is 20 years. And we know that's a big cost to the taxpayer, but more importantly, those vulnerable families can generate an awful lot of misery, which requires government support to mitigate. So it's pretty clear that we should do most things we can to help that young parent and their child out of welfare dependency. If you go on any benefit under the age of 20, there's a 25% chance that 40 years later you're on a benefit. Not because you've always been on one, but because you're likely, once you go on a benefit, you're much more likely to come back to a benefit even after you find a job. So again, it highlights the potential size and focus of investment, and that's why we call it the investment approach, because we are moving to spending literally hundreds of millions of dollars. In the last couple of budgets, we've committed over $250 million to active support for the parts of the beneficiary population who face the biggest risk of staying in welfare dependency. And we've only just got going. You can imagine the challenge that it is to turn a government department into an organisation that thinks in terms of reducing our future costs and operating within a performance framework for government spending. Because too often in the past, government spending has been a bit whimsical. Ministers like announcing programs. No one really goes back to see whether they worked or not. And now we're throwing it into a lifetime scenario. So that organisation now is responsible for that liability. It's their job, formally, to drive the liability down. And our welfare system has never had that clarity of purpose, and we have some optimism from the early results of it that we can make a real difference in the long run. Of course, we will be looking to work with others who can bring to that task their expertise and their balance sheets. We can imagine a future where non-government organisations will have the opportunity, subject to similar performance frameworks, to help us drive down benefit dependency. And this year we've let 2 contracts covering 1,000 beneficiaries each to organisations who will be applying liability reduction processes to those groups of people. For many of them, it will be the first time that government has taken any individualised or personalised interest in their welfare. We're having people turning up in MSD offices. We rang 20,000 people last month. They turn up impressed and distressed. And by that I mean, the minister runs into people who are crying because no one's ever, in 4 or 5 years on a benefit, no one's ever done anything for them or indicated any support. So I've talked about that at some length because it highlights the innovative ways that we can apply your techniques, and maybe even an area where organisations represented here will be able to contribute both to the government's fiscal management but also to the improvement of our community. Because if we've learnt one thing about in the last 4 or 5 years, what works for the community works for the government's books. When we teach kids properly at school, we don't have to teach them again afterwards. When we rehabilitate prisoners, give them skills while they're in prison, they're less likely to reoffend and cost us $90,000 a year again to occupy a bed in a prison. When we protect a child from violence, we save endless misery and almost as much money. So the best way for us to shrink government, maintain surpluses, is for the government to do its job properly. And too often in the past, it's fed off failure rather than thrived on success. We have a fair bit of confidence about where New Zealand can get to over the next 4 or 5 years. And it's partly because of the policy settings, partly because of things that are working for us like high export prices and low interest rates, but most importantly because of the resilience of New Zealanders. We've seen through this period where there have been earthquakes, storms and so on, New Zealanders complaining less than I can ever remember and focused more on getting on and solving their problems and not waiting around for the government to fix them. Although some do write to me telling me they've been waiting around for the insurance company to fix theirs. But that kind of resilience is going to serve us well when we have set a pretty good base for this economy and the world is going to provide some volatility in the future, but also very significant opportunities. And we look forward to watching that unfold. Thank you.
We have got time for 5 minutes of questions, so we've got some mics running around, have we? Yep, we have. A couple of mics. Anybody got any questions they want to raise?
Yeah, I've got a bit of time. I can do a bit more.
Okay, well, I've got one. Now, without putting you on the spot here, Bill, but you know, the EQC review is something that government have been talking about and done some work on. Just, you're among friends here. Could you just, can you give us a bit of a picture of what it could potentially look like? Are we going to see just a minor change to EQC, or are we going to see some significant changes?
Well, I wouldn't want to prejudge that. You'll hear a bit from Jerry, I think, who's been very close to the action. We've got to deal with it on two levels. One is the practicalities of the problems of how EQC cover is defined and how it relates to other insurance cover. And there's some reasonably obvious things there that need to be done. Certainly we all want to achieve the same things in that respect. The second level, though, alongside that, is to stand back and get much more clarity in government about what's the best way to manage and price this risk on our balance sheet, and how much of it has to be on our balance sheet. And there's quite a bit of tidying up to do. So, for instance, just one aspect of it is the connection between our sort of implied underwrite of local government. And we've learnt from Christchurch how those things fit together hasn't worked so well, and I think local government has discovered that its insurance arrangements are, you might say, less than desirable. And so, these are part of the interlocking bits. So our objective at a higher level is to make sure we follow the process I talked about, that we understand the risk, that there's transparency around the prices, and that those are in the hands of people who can best manage them. So that could end up being not much change, except at the retail end. It could end up being a bit more restructuring around how EQC looks. But I wouldn't want to prejudge it. We're being pretty careful about it.
Questions? There's one at the back here.
Good morning. Looking at other jurisdictions, we see a lot of insurer involvement in things like compulsory third-party motor vehicle insurance, personal injury. Picking up on the PPP theme, do you think there are any problems in the personal injury field that private sector insurers could help with in the short to medium term future?
Possibly. You may remember there was a discussion going on around the role of the private insurers and competition with ACC, and then the earthquake simply swept all that aside because the industry wasn't interested and government got very preoccupied. There may be a time when that comes back. We're working pretty hard with. And the situation will be different by the time that debate does come back, because ACC is making very significant progress towards being fully funded, and we're looking at a program which has already delivered some pretty significant premium reductions, levy reductions, and we're looking at quite a lot more over the next 2 or 3 years if we can manage it. And we're talking here about 20 or 30% reductions in premiums. So my guess is that once it's found a new equilibrium as a fully funded scheme, there may be some other interest in it. The big gains for us, I have to say, are around the welfare liability, not the accident liability. So if I can give you an example of the scale, ACC's hardcore personal injury claimants are around 9 or 10,000. We think our hardcore in welfare is about 170,000. Now, they're not on earnings-related compensation, so they don't cost as much, but many of them have similar needs to people in ACC that may well be underserviced, probably are, and many need the same kind of very active intervention at much earlier stages to enable them to get back into the community. So that will be where our focus is for the next wee while, because we see very large scale gains possible if we can do it well.
Thanks, Bill. Just good time for one quick question. That's fire service levy. Remember, you're among friends here. There is a government review going on at fire service levy. Are government giving serious consideration to moving the fire service levy away from insurance to a more equitable funding basis?
I know there has been a review going on, and I'm trying to recall actually where it's got to. I'd probably best to follow up on that. I mean, again, if we understand the principle behind the industry argument, and it's a matter of how you would. That's probably first best, and a matter of how you would turn that into reality. And there's been 2 or 3 goes at it before that haven't succeeded.